Welcome, everyone. Today, we're going to explore the fundamentals of financial accounting, the language that businesses use to communicate their financial story. Whether you're aiming to start your own business, invest in stocks, or simply understand how organizations track their money, this chapter will give you the essential tools. Let's begin our journey into the world of numbers, decisions, and financial transparency. By the end of this session, you'll be able to define financial reporting and explain why it's crucial for businesses. Compare different business structures, such as sole traders, partnerships, and corporations. Differentiate between financial accounting, which serves external users, and management accounting, which aids internal decision-making. Identify the key users of financial statements and understand what they look for. Explain the role of corporate governance in ensuring accountability. Break down the main components of financial statements. Think of these as your roadmap. We'll explore each point in detail, so you leave here with a clear understanding of how accounting shapes the business world. Imagine you're considering investing in a company. Would you hand over your money without knowing if the business is profitable or drowning in debt? Of course not. Financial reporting is how businesses share their financial health with the world. It involves recording transactions, like sales, expenses, and purchases, and summarizing this data into reports that tell a clear story. Why is this important? It provides transparency, helping investors, lenders, and regulators make informed decisions. Without accurate financial reports, businesses would operate blindly, and trust in the economy would collapse. For example, if a company's financial statements show steady profit growth, investors might pour in more funds. But if the reports reveal mounting debts, lenders could refuse further loans. Financial reporting isn't just about numbers, it's about trust and smart decision-making. Let's talk about why the type of business structure you choose is one of the most important decisions you'll make as an entrepreneur. Think of it like choosing the foundation for a house. It affects everything you build on top of it. The business entity you select determines three crucial things. First, your legal structure. Are you personally tied to the business or is it a separate entity? Second, your liability. Could you lose personal assets if the business fails? And third, your reporting requirements. How much paperwork and compliance you'll need to handle. But that's not all. Your choice also impacts your tax obligations. Will you pay personal income tax or corporate tax? It affects your ability to raise money. Can you sell shares to investors? And it shapes your governance. Who gets to make decisions in the company? There are three main options to consider: sole trader, the simplest form where you are the business; partnership, where two or more people share ownership; and limited liability company, which creates a separate legal entity. Each has its own advantages and trade-offs, which we'll explore in detail. Remember, this isn't just a technical decision, it's about finding the right fit for your goals, risk tolerance, and growth plans. The structure you choose today will shape your business's future in ways you might not even anticipate. A sole trader is the simplest business structure. It's owned and run by one person. Picture a freelance graphic designer, a local bakery owner, or a plumber working independently. About the advantages: minimal legal paperwork, just register and start working. You make all decisions without needing approval from others. Profits are taxed as personal income, which can be simpler than corporate tax. And disadvantages: if the business can't pay its debts, creditors can seize your personal assets, your car, house, or savings. Hard to raise money since you can't sell shares. You handle everything: sales, accounting, customer service. For example, a freelance photographer loves the freedom but faces sleepless nights when a client sues and their personal savings are at risk. A partnership involves two or more people sharing ownership. Think of law firms, medical practices, or family-run restaurants. About the advantages: partners divide the workload and bring complementary skills. Combining resources makes it easier to secure loans or invest in growth. Profits are taxed as personal income for each partner. And here are the disadvantages: all partners are personally liable for debts, even those caused by another partner. Disagreements over decisions or profit splits can derail the business. If one partner leaves or passes away, the partnership may dissolve. For instance, a law firm thrives with partners specializing in different areas, but a messy dispute could force it to shut down. An LLC is a separate legal entity from its owners. Think of giants like Apple or small local businesses. Advantages: shareholders' personal assets are protected. Only the company's assets are at risk. Easier to attract investors by selling shares. Viewed as more professional by clients and lenders. Disadvantages. Must register with the government, file annual reports, and comply with regulations. Profits taxed at the corporate level and as shareholder dividends. Shareholders may pressure directors for short-term gains over long-term strategy. For example, a tech startup protects its founders' savings but spends thousands on legal fees to meet compliance requirements. Here is the summarized table about each type of business entities. You can pause the video and have a look. Now let's talk about two very different types of accounting. Financial accounting is like creating an official ID card for your business. It follows strict rules so outsiders can trust it. Management accounting is more like your personal diary. It's private, flexible, and just for your own decisions. Financial accounting produces standardized reports like balance sheets for external users, investors, banks, and tax authorities. It must follow strict rules like IFRS. Management accounting creates custom reports for internal use, budgets, cost analyses, and forecasts that help managers make daily decisions. There are no fixed rules here. Think of it this way: financial accounting tells the world how your business performed last year. Management accounting helps you decide what to do tomorrow. One looks backward with precision, the other looks forward with flexibility. Let's move to the next section, which is users and stakeholders' needs. Financial statements serve as critical tools for a wide range of stakeholders, each with unique needs. Shareholders and owners analyze profitability and dividends to assess investment returns. Management relies on cost and performance data to make operational decisions. Suppliers evaluate liquidity and payment history to set credit terms. Customers check financial stability to ensure reliable service. Banks examine cash flow and debt ratios for loan approvals. Investors study growth potential and risks before committing funds. Tax authorities review revenue and profits to calculate tax obligations. Employees monitor profitability for job security. Governments and regulators track compliance and trends for policymaking. Financial analysts use trends and forecasts to provide recommendations, and the public scrutinizes environmental and social impact to hold companies accountable. Essentially, these documents act as a universal language that supports informed decision-making across the entire business ecosystem, making accuracy and transparency absolutely vital. Imagine a company where the owners aren't the ones calling the shots. This is where corporate governance comes in. It's the rulebook that ensures directors run the company properly, especially when they're managing other people's money. Think of it like the rules of a sports game. Without referees and boundaries, players might cheat or take dangerous risks. Good governance matters because directors might be tempted to prioritize their own bonuses over the company's long-term health. For example, if a CEO hides debts to make profits look better, like what happened with Enron, it can destroy the entire company and hurt employees, investors, and the economy. Governance prevents this by requiring transparency, accountability, and ethical behavior. In short, governance isn't just red tape, it's what keeps businesses trustworthy and stable. Directors aren't just figureheads, they're legally bound to act in the company's best interest. Here's what that means. 1. Can't make decisions beyond what's allowed in the company's constitution. 2. Must prioritize long-term growth over personal gain. 3. No rubber stamping others' decisions without scrutiny. 4. Held to the standard of a competent professional. 5. Can't award contracts to their own side business. 6. Bribes or kickbacks are illegal. 7. Must disclose if they personally benefit from a deal. For the real-world example, a director secretly buying property the company wanted equals breach of duty and potential legal consequences. Now, who ensures financial statements are accurate? The buck stops with the directors. They must prepare statements using proper standards, like IFRS, not just make up numbers. Set up internal controls, think of these like financial seatbelts, to catch errors or fraud before they happen. Confirm the business is a going concern, meaning it won't go bankrupt next year. If there's doubt, they must warn everyone. But directors don't mark their own homework. Independent auditors step in to verify everything, like fact-checkers for finances. If directors fail these duties, they can face lawsuits, fines, or even jail time. That's why this responsibility isn't taken lightly. It protects everyone who relies on those numbers. These are the backbone of financial reporting. Balance sheet, statement of financial position. Oh, what it shows is a snapshot of the company's health right now. Oh, like your personal net worth statement, can be calculated as what you own minus what you owe. Income statement, statement of profit or loss. Oh, what it shows is performance over time, can be the last quarter or year. Oh, a fitness tracker for your business, are you gaining, profit, or losing, loss, financial health? But why both? The balance sheet tells you if the company is solvent and the income statement tells you if it's thriving. The balance sheet has three core parts. Assets are the resources with future economic value, including current assets and non-current assets. Oh, current assets are cash and inventory, used or sold within a year. Oh, non-current assets are buildings and patents, in long-term value. Liabilities are what the company owes. Oh, current liabilities are short-term debts, means unpaid supplier invoices. Oh, non-current liabilities are long-term loans. Equity is the owner's claim after debts are paid. Oh, includes retained earnings, profits reinvested, not paid as dividends. Here is an example of a statement of financial position. This statement breaks down earnings. Revenue, total income from sales and services. Oh, example, a cafe's revenue from coffee and pastries. Expenses, costs to operate the business. Oh, the fixed expenses are rent and salaries. Oh, the variable expenses are raw materials and utilities. Profit or loss is when we take revenue minus expenses. Oh, gross profit is after deducting direct costs, which are costs of goods sold. Oh, and net profit is after all expenses, including taxes. Here is an example of a statement of profit and loss. These reports exist to answer three critical questions. Where is the business financially? Oh, balance sheet shows solvency. How did it perform? Oh, income statement shows profitability. How is cash moving? Oh, cash flow statement, coming later, reveals liquidity. Stakeholders use these like a dashboard to steer decisions, whether to invest, lend, or cut costs. Let's recap today's key lessons. Financial reporting helps make decisions by keeping things clear. Different businesses need different structures. Financial accounting and management accounting have different jobs. Stakeholders need accurate financial statements to trust a business. A good governance makes sure businesses follow the rules and take responsibility. A balance sheet shows what a company owns and owes, while an income statement shows its earnings and expenses. Final thought, accounting isn't just about crunching numbers, it's the language of business strategy. Master it, and you'll see behind the curtain of any company. That wraps up our session. Thank you for your attention. If you have any questions about sole traders, balance sheets, or anything else we covered, feel free to ask. Next time, we'll dive deeper into financial statements. Until then, think about how these concepts apply to businesses you interact with daily. See you soon.